This advice is general and does not take into account your objectives, financial situations, or needs. You should consider whether the advice is suitable for you and your personal circumstances. Before you make any decision about whether to acquire a financial product, you should obtain and read the relevant product disclosure statement. Welcome to our first GFM Wealth Advisory podcast/vodcast, which is very, very exciting. So today from Perpetual, I've got James Rutledge and Alex Patten. Thank you for joining us today, guys. Really appreciate it.
Thank you.
Just chatting before, they've had lots of famous sporting celebrities in here for some podcasts, and they've got us in here as well, which is lowering the bar a little bit, but that's okay. So we're going to start really simple. We're not going to get sort of deep and meaningful, but starting with you, James, can you talk us through your career journey and maybe what got you started interested in microcap investing?
Yeah, sure. So I was on the sell side for almost about 10 years, covering a whole range of different sectors before I joined Perpetual. Almost 8 years ago, I joined Perpetual as an analyst, covering a number of different sectors again, and then started portfolio management on the Pure Value All Cap Fund a bit over 5 years ago. Then the opportunity came to work with Alex on smaller microcap fund about 18 months ago. Microcaps is a really exciting place. You have such a variety of businesses, a variety of opportunities, and you're getting to meet just different founders, management teams that are very energetic about the opportunities, and there's some great earnings stories there as well. So it's a fantastic space to be investing in and one that I'm really excited about. Clearly,
you've been able to put up with Alex for 18 months, which is good.
Yes, a bit of a good partnership, and it's been going well. I've known Alex since I started at Perpetual, as I said, almost 8 years ago, and enjoy working with him. And it's great to be able to work as a team and work closely and bounce ideas off each other, and works well.
So, Alex, a little bit of a different journey. You started as a grad at Perpetual.
I did. Yeah.
So, can you talk us what got you involved in investing in the microcap space?
Yeah, so that was 12 years ago now. You're right. I was a grad in the finance team and was an accountant initially, did my CA qualification, and then had the opportunity to move into the Aussie equities team about 10 years ago now. And when I came in, the first stocks I was given to cover were microcap stocks, and I've stayed in that small cap and microcap space ever since, helping out on the products. Similar to what James said, there's a huge variety in the microcap space, which keeps it super interesting. And just the fact that that part of the market is not well covered, it's often neglected. There's an opportunity to find some great businesses before they get discovered by the rest of the market. And that's sort of the exciting part, coming out of a company meeting and just realising you've kind of stumbled onto a great little business with, excellent management team that people aren't talking about yet.
Yeah. I can get away with this because my wife's an accountant, but nothing could convince you to stay practising as a CA?
Well, look...
No, knows the answer.
They say the grass is always greener on the other side. I think it was in this case.
Yeah, very true. Now, James, you've obviously been investing in the microcap and small cap space for quite a while. The important lessons that you've learned being involved in that space when looking at these stocks in particular?
Yeah, I think certainly picking the right management teams is key. Management teams have even more of a control of the path of the business in microcaps as opposed to larger cap companies. I mean, across Perpetual, we do focus on the management team and the quality of the management team as part of that process, but it's even more important in microcaps. I think also just understanding the cash flows, the balance sheet, and the scenarios in terms of how earnings can play out is really important. And it's, as Alex said, it's much less well covered, that space. You have to do more of your own work, but you have to back your conviction and really understand the companies well and get close to the companies as part of that process. So it's very interesting and a bit different to large cap. You can't just rely on the sell side for all your information.
Yep.
It's quite differentiated.
Alex, I think James might have stolen a lot of your thunder there, but
Sorry.
Is there anything? No, we're all good. What important lessons have you learnt being in the space?
Yeah, I mean, I've learned a lot of lessons, and investing can be often a very humbling exercise. But one other thing in addition to what James said is, I think sometimes the best purchases are the ones that you feel quite uncomfortable or almost sick about at the time, where there's a stock that the market's thrown out that doesn't have any catalysts, where there's a few hairs, but if you've done the work and you've got a view on that business and what it's worth, and you're happy to stick it out over a longer time horizon, which we are, they can turn out to be some of the best investments.
Yeah, there's a famous Baron Rothschild quote about blood on the streets or something like that. But it sort of links into that.
It doesn't feel good at the time.
Yeah, that's exactly right. Now, James, you're at a barbecue and you're having a conversation with someone, and you tell them that you do what you do and you invest in microcap stocks and small cap stocks. What do you think are the common misconceptions about small and microcap stocks that people have?
I think around a barbecue, everyone would reverse broke their best idea that's going to go up 3 or 4 times that, is no one knows about, and it's some new technology, some great commodity stock that, is so far undervalued that, we're talking about it going up 10, 20 times. And, that's how people think about microcap. And those scenarios can happen, but, where we invest in is more that sleep at night type businesses that have an earnings profile. Historically, they have good balance sheets. They can double. They can go up a lot, and they can be quite volatile. But it is in the safer end of that microcap space. So we're looking for proven business models. We're not looking for things that are unprofitable. It's really having that certainty, and that minimises the downside risk as we think about things.
So there's certainly a view in that part of the market that most, if not all, the stocks are highly speculative in nature, but you don't see that as being the case.
No, there certainly is a large chunk of the space that is more that highly speculative space, but no, there's plenty of opportunities where there's proven business models that, as Alex says, that maybe they were once market darlings that have fallen away because of some tougher times. Maybe they've just gone under the radar and just too small for people to take notice. So it can be various reasons why they're not properly valued in our mind, but they are steadier businesses that are a great value.
Alex, can you talk us, so we sort of started at a general level talking about small caps and micro cap stocks as an index in themselves. Can you talk us through the investment philosophy of the fund that you and James manage?
Sure. So we have the same process and philosophy for the microcap fund at Perpetual as we do for our large cap funds as well. We're a quality and value manager. We've got 4 quality filters that a stock must meet before we consider investing in it. So as James said, we're looking for businesses that are profitable. We pay a lot of attention to balance sheet strength, and that's incredibly important, more so as you go into the smaller end of the market.
Absolutely.
And we're also, putting a lot of emphasis on the quality of management teams and alignment there. We're looking for managers who are not only competent but also have integrity. And when you ask them kind of what's not going so well in the business, we're looking for people who are upfront about that, not just talking about the things that are going well. So we're certainly more focused on the downside in terms of how we invest. You're probably not going to find us in the hot stocks of the day or chasing those market darlings. But more practically, in terms of how we manage the fund, it's quite a concentrated fund.
Yep.
There's typically 30 to 40 positions. We run the cash at around 5 to 10% generally, and the turnover of the portfolios typically been very low, around about 15, 20%. So we like to find good businesses and hold those businesses and invest for a long period of time, ideally.
And in terms of a percentage of the index is over 1,000 stocks, isn't it? The emerging, without getting into emerging versus small companies, but there's 1,000 companies also in that microcap space. So it's a very small subset that you guys are picking out at 30 to 40, isn't it?
That's right. Yeah. And part of that is, the filters that we apply knock out a lot of those businesses. Also, from a liquidity point of view, they need to be large enough for us to make a meaningful position in the fund. And in terms of the metrics of the fund, we define microcaps as any stock with a free float of less than 300 mil.
Yep. And just to be clear with the quality filters, if a company fails one, they're out.
That's right. Yes.
Yeah. Pretty hard test.
Yeah. I mean, look, for us, these are, important guardrails in terms of how we invest, and they've been in place for a long period of time.
And has stood the test of time. Now, James, Alex has sort of started talking about this, but how do the two of you go about selecting investments for inclusion into the fund? I guess the process of finding a stock or identifying the stocks and then putting them in the portfolio.
Yep. So aside from just Alex and myself on the fund, we also have 3 analysts that are largely dedicated to the smaller microcap funds, as well as the resources of the broader Perpetual asset management team across large caps that can come all the way down into smaller micro. So we do have a large team in terms of an analyst base. We run a pretty simple screen in terms of trying to see which companies will fit those 2 quantitative quality filters, being the balance sheet and recurring earnings.
And how many stocks does that sort of knock out just to start with? I guess a very large number of them in that microcap space.
It would. I mean, there would be a lot of unprofitable businesses within that. Less on the balance sheet is also, would knock out a number. But, obviously access to debt markets when you're unprofitable is a little more challenging. It's really that profitability piece that would knock out a lot of those companies. And when we run that filter, it's more a historical look back because, there's typically no coverage across a number of these stocks. So we're not looking at forward earnings in terms of that screen. We have to form our own view around those forward earnings, but it's just a very preliminary screen that goes into that process. And then when we perhaps identify companies that are half interesting to us or look very interesting, we'll meet with management teams initially, we'll do some preliminary work and we'll go from there. And for them to come into the fund, it needs to be covered by one of the analysts. And that coverage is a formal coverage note that goes into the system that means that we're covering this stock on a go-forward basis.
Understood. Alex, the due diligence process sounds a lot harder with these sorts of stocks. A Commonwealth Bank or a BHP or a CSL, there's almost a running commentary in the financial press on a day-to-day basis about how these stocks are going, and you obviously got the sell-side research as well. How do you do due diligence on these companies that many people or most people probably haven't heard of?
Yeah, it's a good question. I mean, there's obviously the publicly available kind of information in terms of what they put on the ASX, but beyond that, given how important management is to our process, we always want to sit down with management, at least once and meet with them and see how they talk about the business and how they act. We do, a lot of work building up our understanding of the industry and where the business operates within that industry. So that might include calls, phone calls or meetings with competitors, with former employees or current employees. And then we also like to go out and to see the business, to see the assets, whether that's, walking around the retail store, going out to a manufacturing facility or even out to a mine site. And it gives you some interesting insights, even just, say walking through a manufacturing facility, observing how the management team who you're with interacts with the people on the floor can tell you a lot about the culture of the business and give you some interesting insights. So, I mean, in my time, I've seen a lot of manufacturing facilities. I've done mystery shopping at childcare centres. I've sat by the side of the road looking at digital billboard rotations and all sorts of
that sounds like fun,
bizarre things, which some of them I look back and wonder what I was doing. But all of these things, I think, if you're looking at businesses and you're reading the annual report, it's numbers on a page and words on a page, and it does tell you a lot. But actually going and experiencing the business or seeing the assets is often invaluable as well.
Yep. James, I think we've sort of teased some of this out already, but I guess the unique challenges of investing in this space versus, say, the large cap stocks that I mentioned before? What would they be?
Yeah, I think you've hit the nail on the head in terms of just the amount of focus and coverage that those large cap companies get as compared to where we're typically investing. You might be relying on sell-side research. You might build a model on a large cap company and say, okay, well, my earnings are above sell-side expectations, and therefore I can take a view in terms of how this is going to play out over the next 6 to 12 months. We're really forming a 101 type model in terms of the business that we're looking at. And it's really back to basics. Is this a good company? Is this a quality company at a good price? And how forecastable are its earnings? What's the downside? The upside's fantastic. We can all model in upside, but what can go wrong? We're utilising the knowledge base that we have amongst the team and the resources that are available to us to be able to get into the depths in terms of these smaller companies. And the smaller microcap fund is fantastic in terms of opening doors with management teams and other parties, competitors, for example, that perhaps we wouldn't otherwise get.
Yeah, I suspect that you and the analysts spend a lot of time on those potential downside scenarios in the sense that sort of kicking apart the business model to see what can go wrong rather than what can go right.
We're very focused on that downside, and that comes through in terms of the historical fund performance, where the downside capture is far less than we underperform less when the market's weaker, and we try and keep up when the market's strong. And we think that through time, that's how we outperform the market.
Yep, Alex, I guess in spite of even removing a lot of those sort of binary companies that we spoke about before in this space, how do you manage the fund from a risk perspective, particularly around concentration in single positions? And can you maybe talk us through the liquidity piece that you spoke about at the start as well?
Yeah, sure. Yeah, look, I mean, this is certainly a more volatile part of the market, at least in terms of share prices, but that can also work in our advantage. We can take advantage of that volatility. Often it's only, it'll only take one seller or one buyer to move a stock price a long way. So that's something that, we can take advantage of, as an investor with who's happy to take a longer term view. In terms of managing the concentration and the position sizing, as I said, the fund is relatively concentrated, but typically if we make an investment and the thesis plays out as we expect and the share price moves up or the stock re-rates closer to where we see fair value, we'll be trimming the stock and managing the position there. In terms of liquidity, that can be a challenge, certainly in this part of the market. But what we often find is that as our thesis plays out on a stock, then it might be quite a liquid initially, but as it re-rates higher, that liquidity improves, and that can play out quite quickly at times. So an example, more recently, we bought into a stock called Gentrack about 3 years ago, which is a software billing company. At that point, they'd been through a tough couple of years. The stock was trading around $1.50. A new management team came in and we met them and had a view that the outlook for the business was quite good from that point of view. From that point on, the stock was quite illiquid at that point. But fast forward now 3 years on, and the stock is much more liquid. It's now covered by a lot of analysts on the sell side, and the share price is up at $10, and it's the liquidity's changed very significantly over that time.
It was unloved for quite a while, wasn't it?
It was, yeah. They did go through a tough couple of years, but it's really turned around, and that is the opportunity if you're happy to take that illiquidity on in this microcap space.
Yeah, cool. James, Alex sort of started talking about this with the concentration, but we're very much focused on how your team goes about buying stocks and including them in the portfolio. Can you talk us through the sell discipline and how, I guess, a stock moves from being in the portfolio to one that you might want to trim or one that you might want to exit completely? What might be the rationale for making that sort of change?
Yeah, so I guess we form a view around valuation whenever we're doing our work around certain companies. As perhaps it moves towards that fair value, we may look to have to sell some a bit before it hits that fair value, just given the liquidity constraints and how we're thinking about position sizing within the portfolio. So certainly valuation discipline is very important, and being able to right-size a position relative to where we think fair value is always part of our daily conversations that Alex and I have. The other situation where we might look to exit a position is where the thesis has changed, and that does happen, where perhaps we feel that management's changed the way they're communicating to us, or maybe something in the macro environment has changed such that we think our thesis won't play out the way that we initially thought it may have.
Alex, we've very much spoken about, individual thinking about the portfolio. You and James are stock pickers, i.e. you try to find individual stocks for inclusion in the portfolio. But are there any sort of sectors or themes or industries in the sort of index as a whole that you view as being attractive at the moment?
Yeah, I think there's some interesting opportunities in that energy transition space. So I spoke about Gentrack. They provide billing software to utility companies, and that whole sector, there's a real impetus for those utility companies to be upgrading their software given the changes that are occurring in terms of the makeup of the grid, with renewables becoming an increasingly large part of the grid in many countries. So that's a business that's benefited from that dynamic. Also within that space, we own a stock called LGI, which we've owned since the IPO a couple of years ago. What they do is they go out and sign deals with landfill owners, and they go in and extract the methane from the landfill sites, and then they either flare the methane gas and receive carbon credits, or they use that to generate electricity. And they've been investing increasingly in batteries, which enables them to take advantage of some of the inefficiencies in the energy market at the moment. So that's a really interesting little business that is, I guess, at the cutting edge of that energy transition and what's happening with the energy market at the moment.
Yep, absolutely. James, I think one of the questions you might get at the barbecue is around sort of investing in this space and emerging technologies or disruption or innovation or those sorts of things. Is there anything in the portfolio at the moment that you've got in that space, or anything that's interesting at the moment?
Yeah, I think really in terms of that technologies piece, again, I hate to sound boring, but we're just looking for proven technologies. We're not looking for things that are unproven that may work out. I mean, the upside is fantastic if that's the case, but for us, that's just too much risk, and that's not in our wheelhouse of knowledge, and we kind of know what we don't know there. And so I think that when we're looking for opportunities, it's where is that proven technology? And as Alex touched on, Gentrack's a great example in terms of a business that had the technology proven, fell on some tough times, but then has managed to come back and it provided a great opportunity to establish a position. I think another stock that kind of fits that space is within Wagner's. You think, okay, it's a construction materials business. How am I going to talk about technology here? But they have a division that's a composite fibre technology business that actually goes into power poles and cross arms for use in electricity. Also, it goes into footpaths and things like this. So it's a bit of a unique product. It's now generating a profit in Australia. The business is break even in the US. So it's part of a larger part of the business is in that core construction materials, but it's an interesting technology piece that could be a pretty meaningful part of the valuation in a few years' time.
My next two questions, I love asking stock pickers these questions because they have an amazing ability to answer the question without answering the question. So, Alex, the current economic environment, how does the current economic environment and all the noise, how does that impact upon your portfolio construction?
Yeah, I mean, it's a very uncertain environment at the moment. We read the same papers and things that you do, and there's no shortage of opinions. I guess we have the opportunity to speak with lots of management teams throughout the year, and I guess our sense in talking to them is that, whilst the domestic economy has been challenged over the last 12, 18 months and growth's been pretty muted, conditions have stabilised over the last little while, and we were kind of heartened coming out of the most recent reporting season that a lot of our companies are seeing conditions that are at least no worse, or maybe there's some green shoots there. A lot of the positions in the fund are very much exposed to the real economy. So there were some positive signs. In terms of how we think about the macro and how we put the portfolio together, we want to take a long-term view on stocks, but we try and form a view of where we are in the cycle for the stocks in terms of the relevant cycles that they're exposed to, and always bringing it back to where we think the sustainable earnings are and what the right multiple is there.
Yep.
Because that can create an opportunity where we get to buy some cyclical businesses that may have near-term headwinds, but where we see real value over 2 or 3 years, we're happy to take that on.
Yeah, that's, to your point, that economic noise can sometimes push things below what you feel is fair value and give the opportunity to perhaps enter a stock at a level that you may not have thought was possible. That's
right. And the caveat there is if that's the situation, the business needs to have a strong balance sheet so that they can withstand that tougher period. And often, that tougher period might extend for a bit longer than what you expect as well. So you need to be prepared there in terms of balance sheet strength.
And I guess from a sell perspective, you can also see things sort of irrational exuberance and things shoot above fair value because of a view of the economy, and you guys get the opportunity to sell stuff as well.
Yeah, I mean, businesses are typically a lot more stable than their share prices. So if we can take a step back and try and be rational, then we should be able to take advantage of that.
Yep. So you do take a view of the cycle in terms of where you're looking to include stocks in the portfolio.
Yes.
Are there any areas that you're avoiding because of the economic climate, or you don't view it that way?
It's probably, because the funds sort of bottom up.
Yeah.
Yeah.
I think from especially the micro perspective, it is very Australian-centric fund. And so perhaps some of the risks around the tariff environment and others, create some risks that perhaps this space isn't as exposed to. So it is insulated in some ways from some of those other risks.
Yeah. Jumping on to that, James, perhaps the thing that people like to talk about as much as the economic environment is the geopolitical environment. I'm not sure whether you guys knew, but there was a US election in the last little while. I just caught up with that. How do geopolitical issues potentially impact upon portfolio construction?
I think it's more, again, to Alex's point, it's more how does it factor in bottom-up stock picking.
Yep.
And less about we're mindful of that macro, we're mindful of what's going on in the world in terms of constructing the portfolio, but how does it impact our stocks on a day-to-day basis? We've got a position in Kina Securities, the second largest PNG bank, has fantastic returns on equity. It's cheap, but it operates in a pretty uncertain environment in PNG, and that's something that we have to be mindful of when we think about valuation, when we think about the risks of seeing fair value for that kind of security. Another stock that we have a position in now is Metro Mining, the bauxite miner that has a bauxite mine in far north Queensland. It's benefiting from the situation in Guinea at the moment, where there's been a disruption to bauxite supply coming out of Guinea because of some disputes in terms of the miners and the Chinese companies that mine in Guinea. So, these are risks that you have to be aware of, and in terms of how they play into stock-specific situations. But in terms of the micro fund, it's less of a overall portfolio issue because it is so Australian-centric.
Might ask you both this question. ESG, an acronym that probably we didn't know about 15 years ago, which is environmental, social and governance. How does that come into how you view individual stocks for inclusion in the portfolio, Alex?
Yeah, so an ESG assessment's been part of our process for a long period of time. All the analysts have to include that when they're submitting a stock into the universe and update that ESG assessment every year. I think for this fund, probably the focus historically has been more around the G.
The G, yeah, the governance.
On the
I was going to say it's
governance
being pretty much part of one of the 4 pillars.
Yeah, and we do see ourselves as active investors. Often in this small cap and micro cap space, we own large chunks of these businesses, and we've owned them for typically a long time. So we've developed pretty strong relationships with management and the board, and we are on the front foot around what we would like to see from them. Not so much in terms of the operations, but more around capital management and M&A and things like that. So we are very active, but it's really that governance side that's critical for us.
Yep. James, anything you wanted to add to that around the ESG piece with the portfolio?
I think, as Alex said, it's really around that governance piece, getting comfortable with management, with boards. Yeah, I think it's been a rocky few weeks for founder-led companies, and in this space there are
really. I hadn't noticed.
Catching up on a bit of the news the last few weeks.
Yeah, just catching up. Yeah,
and making sure that from our point of view that the governance structure is in the right place, because it can get a bit murky in some of those situations, and that's an important part of the process is meeting with boards separate to management. And understanding the dynamics there.
Now, believe it or not, we've progressed from the easy questions to the more difficult questions. So I guess one of the tougher questions I can ask you guys is, it's been a really tough environment for small caps and micro cap stocks relative to the large cap space. So Alex, could you sort of talk us through why you think that has occurred, and maybe also what gives you confidence that that won't continue to be the case moving forward, taking a medium to long-term view, because the short term is very, very hard to predict?
Sure. Yeah, I think there's a few reasons. If you go back to 2 or 3, probably 2 years ago, when interest rates started to increase rapidly, we definitely saw investors move up the market cap spectrum as they went sort of risk off, and there's certainly been a crowding into the ASX 100. I mean, all you need to do is look at the valuations of some of the top 20 stocks, including the big 4 banks relative
obviously
to history.
Yep.
Also, the index composition between the large cap index and the small cap index is different. You've had the banks making up a big part of the top 100, and those businesses have really benefited from rising interest rates in terms of their net interest margin expansion, whereas there's certainly more exposure in the small odds to those cyclically sensitive companies. So
I guess this has been a global phenomenon too, but perhaps in the US, for example, it's been the big tech stocks rather than the banks that have created that performance differential.
Yeah. So in terms of what changes that, look, I think as we get closer to interest rate cuts, or as we get closer to people being a little bit more comfortable and confident around the domestic consumer, I think there's a lot of stocks in the small and micro cap space that are touching the real economy and that are trading on very low multiples on earnings that we think are cyclically quite depressed. It's not all of the small cap market, but certainly we're quite optimistic about our portfolio. The forward PE of our portfolio is only 11 times, which is a big discount to the market. And we think these businesses, a lot of them have been through a tricky 12, 18 months. But as I said before, in talking to them in August and looking at the data, it feels like the environment's on the improve. So we are quite optimistic around that smaller and micro cap part of the market.
James, I can't imagine your view is going to differ much from Alex's, but your view looking forward in this space, ignoring what's happened in the past?
Yeah, I think as Alex touched on, I think certainly in February we had a number of companies really feeling the pressure from what was going on in the economy, and they had to right-size their business, cut costs for the new outlook, and things haven't gotten worse since February for the broader economy in terms of where our companies see it. And August was they reaffirmed that, and so I think they're well set up. I think as Alex touched upon, the value part of the market has really been left behind. Despite the underperformance of small caps relative to large over the last number of years, the small industrials is trading on 24 times 1 year forward, which is 20% premium to the ASX 100 1 year forward multiple. So notwithstanding the underperformance, actually the 1 year forward PE is actually higher in smaller industrials than it is in large.
Yeah, wow.
So you do need to see earnings growth come through to justify that. But
is that off? Well, that's a looking forward. It's not past PE. It's forward looking PE. Yeah. So earnings definitely do need to come through, don't they?
They do, and I think you've seen in this market certainly over the last 12 months the market reward earnings certainty and earnings upgrades. So companies that have met expectations or slightly beaten expectations have enjoyed huge re-ratings. The platform businesses have gone from 30 times 12 months ago to 50 or 60 times multiples with only EPS revisions of mid-single digit 5% or so. So where we're investing, it has been a bit tougher because, as Alex says, these businesses touch the real economy and they have had a tough earnings period. But as we look forward, the earnings are looking more certain and cyclically depressed, and the starting multiple for the micro fund is just 11.2 times at the moment,
which is a really big discount to the small industrials,
which is a huge discount. Yeah, and it's paying a 5% dividend yield as well. So we think the starting point is really attractive, and that's a great environment to what you're paying and where you start from is really important in terms of what kind of returns you're going to see.
By far the toughest question. I don't like to say favourite stock because as stock pickers you try not to fall in love with stocks, which is good. But one stock in the portfolio to talk about, Alex, that you like it as a long-term investment proposition.
Sure. I mean, a stock that we've held for a long time already is Capral. It's an aluminium extrusion company based here in Australia. So what they do is they take aluminium billet and they extrude it and turn it into things like window frames and door frames. But they've actually grown their commercial and industrial business quite strongly over the last 5 years or so. So there's a lot of uses in terms of building boats or caravans and things like that. And the reason why we like it, it's got about 170 mil market cap, net cash of around 70 mil, so an extremely strong balance sheet. It's trading at a big discount to its net tangible asset backing. And in terms of the business is certainly exposed to the residential housing cycle. That's about 45% of their volumes. But we do feel like we're getting close to the bottom of that cycle in terms of new housing starts, and there's a lot of noise around what the government needs to do or is going to do to increase housing supply. So we feel like we're closer to the bottom of that cycle, and even so, the stock's trading on around 7 times earnings this year. So we think it's exceptionally cheap, a well-run, well-managed business that can trade a lot higher, hopefully, from these levels.
The earnings or revenue that it's exposed to that residential housing market, has that sort of been at that level, or has it been decreasing?
It's certainly come off over the last 12, 18 months. Their volumes have come off, probably around about 5 to 10% across the business. So probably 15% across the residential part of the business. But what Capral did, going back 5 or 6 years ago now, was they took a lot of costs out of their main manufacturing facility up in Queensland at Bremer Park. and it improved significantly the through the cycle earnings of that business, which we think the market's missed that. So they're still generating very strong earnings this year, even with volumes on the resi side having come off quite significantly.
Last but not least, James, a stock in the portfolio that you really like?
Yeah, a more recent addition to the portfolio has been Wagner's. This is a business that we've followed for a number of years. When it IPO'd in 2017 at $2.70 a share. We didn't participate in the IPO. It went up to $4.90 and we looked a bit silly at the time. They've had a few issues since that peak and the stock fell quite considerably down to 60 or 70 cents over the following few years for various reasons. We started looking at the business again going back about a year ago, thought things look to have bottomed. It's a construction materials and cement business that's largely exposed to southeast Queensland. So again, that residential exposure, but slightly different in terms of residential, commercial and infrastructure exposure. The southeast Queensland market is set for a great time ahead of the 2032 Brisbane Olympics. So the market is certainly growing very strongly. We started building a position post the February results where the company looked to have turned a corner. It was generating good cash, starting to pay down that debt. Wasn't an expensive valuation at about 8 or 9 times 1 year forward earnings. And we started to build a pretty considerable position in the micro fund. Through August, again, they reported a great outcome. Stock didn't really move. We kept buying the stock. I think our average price was about 85 to 90 cents. And then on no new news in the last 4 weeks or so, the stock shot up to about $1.30. So to that earlier question in terms of volatility, that volatility can be there
on the upside as well.
On the upside, which is nice. So from here, it's not expensive. It's still probably 1 year forward 13 times. It's got some great optionality in terms of that southeast Queensland market, and then in terms of that technology, composite fibre technology business that I talked to earlier, that's also a business that in the US can be quite meaningful and is just break even at the moment.
Great. Thank you, James. Thank you to both of us for joining today. First ever GFM podcast. So we really appreciate you both joining us. Hopefully we can get you back on again one day. Thank you.
Absolutely.
Thanks for having us.
No worries at all. Thank you.